Okay, hello everybody, and welcome to Investing with IBD, sponsored by MarketSmith. Today is August 5th, 2020. I'm your host, Arusha Paris, and today we have Dan Fitzpatrick returning back to the show. Dan is the founder of StockMarketMentor.com and OptionMarketMentor.com. Thanks for being here, Dan.
Hey, happy to be here. Thanks. Had a few little sound issues here and there, but finally got her figured out.
Absolutely. On today's podcast, we are going to talk about the current markets. We are going to talk about trading psychology, and then we will end the episode with a few current ideas. So let's get right into the current market. The market continues to be in a pretty strong uptrend. We have 2 distribution days on the NASDAQ, 5 on the S&P 500. Dan, what are your thoughts about this strong and crazy market?
Yeah, I think it's a typical wall of worry thing. I've never seen a wall of worry like this before, and I've been trading since the mid '90s, and at least like the one in the back in the late '90s, that was a huge wall of worry with, we're in a bubble, and they're looking at these stupid websites that are valuing them on eyeballs and stuff like that.
Yeah.
But the thing is, that was the type of thing where everybody's just looking for the bubble to pop, but there was really nothing out there to make it happen. It was also going on for literally years. Mm-hmm. Compare and contrast that to what we have here, where we do have the economy falling off a cliff. Of course, it's self-imposed. It's kind of like taking a knife and stabbing yourself in the heart. You've got a gushing chest wound, but it was kind of self-inflicted. So the thing is, though, everybody's worrying about that type of thing, and the market keeps going up. I know it's something that's bothered me for a while until I finally just stepped back and looked at it and said, wait a minute, the market is not acting bad, and it's actually not acting illogical. I would rather own Dell than Delta. I would rather own Amazon than American Airlines. And so if you look at what's happening in the market right now, it's kind of a bifurcated market where, frankly, the stuff that's not supposed to work isn't working. And the stuff that is supposed to work is working. You look at the cloud computing sector. There's just all these, what I would call COVID stocks, whether it's Amazon or Apple or Facebook, anything that makes money by people sitting in front of their computer with nothing to do. Mm-hmm. That's the stuff that's running the stock market higher. And doesn't that kind of make sense?
It makes tremendous sense. The other thing that is going on, along with the people staying at home and buying things on the internet, is a lot of other people working from home now. And you see all those companies and that are providing those type of services that enable a lot of companies, like even us, like here at Investors Business Daily, to work at home and really increase productivity by staying at home and avoiding the commute.
Yeah, and we'll talk about, I have some stocks I want to talk about later that are just directly on point with that. But, the thing is, I don't think we're ever going to go really kind of back to normal. I think we're still kind of searching for the new normal, but I don't really feel like the new normal is going to be much different than it is right now. I think we just kind of have to get used to it, that people are going to stay at home. I know I've been fortunate enough to be able to work from home for the last 20 years or so, but we do have an office. It's very close by, and I never go to it anymore. Like, why do I want to do that? Right. I think that companies are ultimately going to wind up saving a lot of money by getting rid of their offices. And I think that people are going to learn, if they haven't already, how to be more productive at home.
And it'll be really interesting to see if now we're based here in Los Angeles, and if all of a sudden we have this policy that you can work from home pretty much all the time, you all of a sudden open the company up to even greater access to talent from all over the country and even the world. So it'll be really interesting to see what happens to the country as all these businesses realize that they can really function pretty well, and most of their employees are at home.
Yeah, I mean, first of all, tell me that you don't miss the 405 freeway. I mean,
Not at
come
all.
on. The 10, the 405, you got to be from LA to know what I'm talking about. Let's just say it's a mess. But yeah, when you really think about it, yeah, local is, it used to be somebody you can commute into the office. Now local is like, I don't know, on this planet. If you have a fast internet connection, you can work for anybody. So, there really is there are a lot of positive things that I think are going to come out of this. I mean, it's a tragedy the way all this stuff has happened and the way it's unfolding. But, when it comes to money doesn't really care about that. I mean, I can worry about it after market hours and on weekends. I don't anymore. I just kind of accept it, and I can't do anything about it. So why am I going to worry about it? But when it comes to making money, I'll make money on anything. If there's a huge epidemic of smoking, I don't care. I'll buy Philip Morris, even though I feel bad for all the people smoking those cancer sticks. And with respect to what's happening now, I think you got to just look at things objectively and not be so worried about what's going to happen in the future. Look at what's happening now and look at the trends. You stay away from the financials and get into the companies that are doing really well and their charts are showing it. And then the other thing that's really important, because we all do kind of have that little wall of worry. The other thing that's important is don't disbelieve the trend. I mean, I got to tell you, one of the biggest challenges that I ever had, I still have it every so often, I guess just between us, maybe more than every so often, is I sell too soon. I hear Bernard Baruch, famously said, I made all my money by selling too soon. I don't think that's really the way to go, but I guess it depends on how you define selling too soon. The toughest thing to do is look at your stocks and you see something that's doing really, really well, and you just want to ring that cash register. And frankly, a lot of times the best stock to buy is the one that you already own. And so maybe you should just buy more of it. Raise your stop a little bit, keep piling in. I know that's what the big guy used to do all the time, Bill O'Neill.
Absolutely.
Right? Wasn't he like a huge size trader?
Yeah, but he would a lot of times, and what Dan's talking about here is the concept of letting winners run. The ones that are working for you, a lot of times when you're in a strong trend, the best thing you can do is just let those stocks work. Now, Bill kind of took it to the next level where he would continue once he figured out, okay, this could be the best stock in the market, and he had a very, very good knack of that. He would just slowly and consistently add to the stock at proper points and things like that. Yeah. But and by the end of a major rally, he would have this monster position. Now, you don't have to do it that way. That's what I've learned over the years. But you do want to make sure you're letting your winners run and letting them work for you and not getting fully out of the positions too early.
Yeah, that's right. And you know what we're talking about with respect to Bill O'Neill, that's the extreme.
Yes.
That's the extreme. And, which if you've got the skill and the experience and the guts. I was going to say something else, but if you got the guts to do that, then certainly that'll work as long as you're right. But we should all be thinking along those lines. Like, wait a minute, I've got this thing that's working. Do I have enough exposure? Am I going to get paid off for being right? Because I'm darn sure going to get penalized when I'm wrong. So am I going to get paid off enough? And and the other thing that's important for people to remember is you don't add to losers. Like the old saying goes, losers add to losers. But for me, I just look at it really simply. If I have a positive figure on a position, then that means I'm right. Okay, so that's the one I want to focus on. If it's negative, I'm not worried about trying to be right. like the market doesn't care, the stock doesn't care. I'll be out of a position if I get shaken out a few times. I'll probably move on, and not because of superstition or anything, but it's just because, well, I obviously don't have a feel for the stock, so I'll go do something else. But you want to be able to compound your winners, and another reason for that I find, because at Stock Market Mentor, I have to find ideas for people every day, because we have new members coming in every day. And it's, it's kind of thin gruel for somebody who's in today. And I say like, whoa, you should have been here a couple of weeks ago. We're crushing it on stamps.com, but you can't buy now.
Yep.
So you have to come up with ideas every day. But a lot of times, the best idea is the one that you had yesterday and last week. It's just at a different entry point, So I just look at the research that we do as one of exclusion, not inclusion. I want to exclude all of the stocks, the possibilities that I could choose from in order to make a really crappy trade. And I just want to be looking at stocks that meet like a fundamental criterion. And if I can do that, then I totally avoid the, this time is different mentality, which we all have struggled with, or maybe still do. Where you just look at something and go like, oh, no, I got to feel about this. It's different.
Yeah, and that's where the emotions can definitely get you in trouble. Now, another huge part of doing well in the markets and really surviving the market. I never look at it as thriving the markets. I look at it as surviving the markets. Now, in markets like this, everyone's going to do well, but probably the one of the first things that everyone needs to get down in the beginning is coming up with a good plan and really planning your trade and then trading your plan. So Dan, why don't you talk about some of the things you do, or some of the planning you do before you even enter into a stock?
Okay. My plan is, I don't have a lot of unique things, but I do stick to them pretty rigidly. And when I don't stick to them, it's when I lose money. I only look for stocks that are in uptrends, and that's just real simple. 200-day moving average has to be rising, 50-day has to be rising, and the general trend has to be rising too. You can throw in like 150 or this or that. As long as the price is above the 50, which is above the 200, and they're all moving in the right direction, then that is, if there's any kind of volume at all, that's an indication of institutional buying. And to me, that's where it starts. I want to, if I would get like emails or texts from all these institutions that would tell me what they're buying, I would never have to look at another chart again. But they don't do that. So that's an indication to me that institutions are buying. So that's kind of my, that's my draft list, so to speak. But then from there, I look at MarketSmith a lot, and I look for, a lot of people require a relative strength rating of 80% or something like that, or an EPS rating of 80%. Right. I like to look a little bit lower, because a lot of times you'll find that the EPS ratings that are about 75 to 78% that are actually below like Bill O'Neill's requirement. Yeah, those are tomorrow's winners, because they kind of slip under the radar for a lot of people. So I look for areas of consolidation. The closer a stock gets to the 50-day moving average, and again, it's a rising stock, the more interested I become. And I'm looking for these volatility squeezes, what I call them. I use Bollinger Bands to find them, but where they're trading in a pretty tight range. And if you can find a rising stock with good fundamentals, good growth fundamentals, and it is kind of pinching close to the 50-day moving average, man, that is an opportunity just waiting to happen. And
so Dan, you're talking about so the stock's been working in a nice uptrend for a while. Now it's coming back to the 50-day. Yeah. And now it's tightening up. The volatility is contracting. You're starting to see the volatility squeeze in the Bollinger Band.
Yeah, and you can compare that. You can contrast. I mean, I don't know if we're looking at charts right now, but you can look at Netflix, for example, which fell. That fell a lot, and it did, if I recall correctly, it came really close to the 50-day moving average. Okay, that, and then it rebounded. That didn't really interest me. That didn't really interest me that much because it fell so steep. Like the fall was so steep that you just know.
So you're talking about around here.
Yeah. Like if you look, I mean, that stock fell from above 550, whatever it was at one time, clear down in a couple weeks. I mean, it was really steep. So it leaves behind a lot of ticked off bulls, people that bought the stock, and now they're sitting there and they can't wait to get their money back because there's some other stocks that they'd love to be buying instead. So you compare that with like Shopify, and you can look at that and see. I think that's, well, it doesn't matter. I think that might be an arithmetic chart, but
this is. Yes.
But it's actually the fall from that 1100 level down to close to the 50 was actually much more gradual.
Okay.
And it occurred on lighter volume.
Yep.
And so that's an indication of what you would just call weak hand selling. It doesn't mean, dumb selling. It just means people, I go ahead, the stock's not moving up, so I'll go ahead and sell it. Right. And then right underneath there are institutions kind of waiting to buy it. And so that is a much more interesting pattern to me because it's a moneymaker, so I look at that and you look at the fundamentals and they're all, they're monster fundamentals. Nothing wrong with that. And the other thing that I like is like the relative strength line is rising, which I know a lot of people look for, but again, we're just kind of talking about things that I look for. As long as the relative strength line, as long as the number is still okay, like it's got to be above 90, I really don't care if it's falling a bit. And this is why, think about this, it's only logical. If part of my criterion is I want to see a stock that's kind of drifting sideways and even preferably even kind of down a little bit on a little volume. Well, if we're in a strong market, then that stock is going to be underperforming. But I look at that as the same thing as looking at somebody running a race. You can be the fastest runner running an ultra marathon or something, but at some point, you're going to stop and catch your breath and you're going to rest a little bit. So relative to the rest of the field, you're pretty slow. But then once you get a rest and you start running again, now you're going to rush right back to the front. And so, I look at that stuff, and to me, it's just kind of applying logic to it. And so that makes sense to me. So I don't really want to be so dogmatic in my trading or my stock analysis that I don't leave room for thinking, and because there's kind of an art to it as well.
There's tons of art. One other interesting thing that you mentioned before, when we were talking offline, it is and makes sense. So we all do this. You learn to do this after you've been doing this for a while. But before you enter a trade, you've determined a number of different points. Entry, where your exit strategies are, how much you want to get into it, and things like that. Just briefly talk about it, and then we can take a quick break, and then
okay. Yeah, that's the most important thing, because if you have specific entry criteria, then you look and say, oh, when the stock goes above 80, boom, I'm in. Okay, well, how much are you going to buy? How many shares? Where are you going to put your stop? All of this really, really matters. And you can figure all that stuff out in advance. You know what your ideal beginning position size is, maybe 10%. So you can calculate that by the price of the stock that you're buying. Where's the stop going to be? If it's a tight stop, you can buy more shares. If it has to be a loose stop, well, first of all, maybe you shouldn't be buying it anyway. But second of all, you can buy fewer shares, because what you really care most about to begin with is how much you stand to lose. So you figure that out, and then you put yourself in a position to make money by understanding how much you're risking first. Then you focus on building a bigger position.
Perfect. So
Was
the
that
market
quick enough?
I'm very impressed, Dan.
Well, thank you very much.
The market continues to be in an uptrend, but remember, we are still in earnings season, so make sure you know when your stocks are reporting earnings. So let's take a quick break, but when we return, we're going to continue this conversation and talk more about psychology and post-analysis. We'll be back. I am here with Scott St. Clair. Scott's one of our senior product coaches at MarketSmith. Now, Scott, there are a ton of publicly traded stocks just on the U.S. I think it's over 5,000 stocks. Who has the time to go through all of these stocks and find the very best ones?
Yeah, most people don't, right? So what you need is a tool like MarketSmith. We have decades of research on what makes a great winning stock. So we've done all the research for you. So we're going to try to highlight those specific stocks with those great data points. So if you're looking for that next great potential big winner, orange stock ideas button, you just click on it and you've got some of the main reports that we use, including the Growth 250.
Yeah, and the Growth 250 is the first list that I go through on the weekends.
Yeah, it's the most popular one, but there are others. There's the Breaking Out Today, Stocks Near a Pivot, and then the Blue Dot list, right, which is very popular. It's going to show you the stocks with the best relative strength. So we've done a lot of the work for you. What you have to do is review these lists. You're going to come up with some of the best ideas in that current market environment.
Perfect. MarketSmith saves you time and makes investment research that much easier. For more information, go to investors.com/podcast2020. Dan Fitzpatrick's our guest on Investing with IBD, sponsored by MarketSmith. Okay, Dan, let's continue this talk about psychology, because you can really never talk about it enough, because that's what we're doing every day. We're trying to figure ourselves out in the market. And so really the best way to do that and really start understanding how you react to stock movements, especially when they go through these extreme runs, is by doing post-analysis. And so let's talk about like what you do and how you use self-reflection to get better in the markets.
Yeah, that's a biggie. First of all, it's actually really, really easy to learn to trade. I mean, you can look at, as long as you're a good note taker, look at all the things on IBD's website, just the basic free stuff. You're going to look at all the stuff that I have at Stock Market Mentor. We have a lot of free.
Yeah, you can get on a free
you can go on YouTube, I mean, some of it's crap, but a lot of it's really, really good. I'm going like, why is this guy posting free videos on YouTube? Hey, man, you got to come work for me. But the thing is, you can learn how to trade, but then actually doing it, that's a different deal. And there have been times in the past where I've actually thought, I should hire a trading assistant, somebody to do exactly what I tell them to do, and then never take direction again. Like if I just say, okay, buy this and hold it until blah, blah, blah.
That is interesting.
And then if I come into the room like 2 days later or a week later and say, nah, you got to sell it, have the assistant look at me and go, nah, we covered that before. Not going to do it. Get out of here. And what that is really like my trading assistant is my logical objective side. And then I am the objective guy that's always overthinking things, always taking profits too early because I'm afraid it's going to turn into a loss, or because I just took 3 losses in a row and I'm feeling really bad. So I got to ring the cash register to feel good about myself. In none of those instances does the stock do anything different. And so that's the challenge that we all have, is we fight our worst enemy, which is ourself. And you wind up doing the exact wrong thing at the exact wrong time. I mean, I don't even want to tell you the stocks that I sold way lower than they are right now. And if I go back and look at the chart, and I have, to see where I sold it, I can't even tell you. I can't even tell you, well, it did this and volume was that, or it broke this trend line. It's just like, I don't know, maybe I was having a bad day or something.
Yep.
It really is pretty remarkable how we get ourselves all screwed up. And the one thing that I've done that is essential for anybody who wants to be a consistently profitable trader. Every single person, there's no exception. If you're out there listening or watching to this podcast and you're about to say, nah, that's not me. Actually, no, it is you. That is, track your trades. Look at your trading behavior, not how great you are at stock picking. Did you make any money on it? Are you consistently making money? What's your average loss? What's your average profit? What's your batting average? What's your average holding time? Look at the charts, not the one that you sold yesterday, but look at the charts of the ones that you sold last month. Put a little green dot where you bought, put a little red dot where you sold. That will tell you so much. We have a common friend who told me to do this. This was a few years ago. It's Mark, Mark
Yep.
Minervini is an awesome guy. And I was telling him, like, dude, I'm kind of, hate to say it, but I'm kind of having a hard time with consistency here. And he goes, print out all your charts, get a red and a blue, and, do that. And he goes, bring them to me and it'll take me 15 minutes. And I can tell you exactly what you're doing wrong. Yeah. So I'm going like, oh, okay, well, this is really an ego sapping experience, but okay, I'll do it. And so then in the process of doing it, it took me like 2 damn weekends at the office to print out all these things and mark them up and all that. I looked at them all and went like, I called him up. I go, dude, I don't need you. I'm selling too soon. Thank you very much. That's
awesome. Yeah. I mean, it's a great example because a lot of times it's almost for everyone. You're going to do the same thing over and over again. You just don't realize it. And you need to do what Dan just did there, print them out, mark them up. And then it really is obvious at that point. Like, oh my, and that was, for me at first, I wasn't selling soon enough. That was my first big thing. I'd write some of these stocks down like 80% because I thought, oh, maybe they'll come back. Then once you get that out, then I was selling too soon. And so you start getting better at that. And then you sometimes have to go back and relearn some of these things too. And some of them I have to learn many, many times. So, but the only way you do that is you have to do that hard exercise of looking at those bad mistakes that you made. And it's never fun, but the more you do it, the quicker you're going to get yourself out of that rut and set yourself up for the next great market.
Yeah, I will tell you this. Again, if you're listening or watching and you think, well, you don't need to do that, you are so wrong. You are so wrong. You're fooling yourself. You're stroking your own ego. Basically, you don't want to know how bad you suck. I don't know if I can say that, but I just did.
Feel free.
Yeah. So, I mean, seriously, you just don't know. And if you say, well, no, man, I'm doing really great. Okay, then fine. Analyze your trades and figure out a way to do better, because that's real. And like one of the things that I'm telling our members, because we have people we got some that are day traders, some that are swing traders, some, that have been holding AT&T for 30 years, or something. I mean, sure, whatever. But I always tell people, if you're trading a stock, it's a good company, but you're just kind of itching to sell the stock, keep 10% and just say, okay, I'm up 20% on my position or whatever. And that's like a really good time to take profits. But you know what? I'm going to keep 10% and just like my stop is at break even. So if I ride this thing all the way down to where I bought it, it's really okay. And what you're going to find is that you will have the experience of holding a stock for longer and typically getting paid off for it. And after a while, because again, I can't give any specific rules for that. I can just give you a specific experience. If you're buying good stocks and then you find you're kind of selling them too soon, just resign yourself to selling 90% of it, hopefully in stages. And you go like, you know what? I don't care. I'm just going to keep it. I'm going to keep 10%. I'm going to put it in a group in my account and never look at it. I'm going to have my stop down at break even and forget about it. You'd be amazed at how your trading improves. That's the biggest thing, man.
No, that is a really important thing. That's actually something that I've done in this latest rally too, and some of those were really small positions, and they just went up they've gone up these a monster amount. Now let's talk about another benefit of post analysis, and part of the exercise is coming up with some new rules, because in the end, you can go and read Bill O'Neill's How to Make Money in Stocks book. You can watch your webinars on stockmarketmentor.com.
And you should.
Yeah. And exactly. But there comes a point also, once you learn a lot of the main rules, that you have to write rules for yourself to adapt them to your personality and your trading style.
That's a big deal, because everybody's style is a little bit different. And, maybe other people have it down cold. I don't. And mine's always evolving based on some of the things that I just said. Maybe I shouldn't be saying that stuff because I want people to think I'm the world's greatest trader, but I'm not. I'm a human. I make mistakes too, but I'm getting better. All the time I'm getting better. Every year. The way I'm going to be trading next year will make today's Dan be embarrassed, so you constantly get better. But the thing is, what I've been working on is holding my trades for longer. And I do have specific rules for that. I never buy all at once. I never sell all at once. If I ever get more than 10 stocks in my account, I start looking to cut somebody from the roster because it's too many. Mm-hmm. I mean, if I've got a 5% position in a stock and it doubles, that kind of barely moves the needle, on my whole account. And it's hard to find stocks that move 20%.
It really is. Yeah.
You know what I mean? And so I really try to start at least typically with 10% as a starting position. And then I keep a pretty tight stop to make sure I'm not, I never want to lose more than 1.25% of my account in any trade. That's not risk more. It's not like put more than 1.25% of my account in a stock. It means difference between the entry and the stop multiplied by the number of shares shouldn't nail you for more than 1.25% of your account. I think it's probably a little bit on the tight side, but I think it's pretty common that people do that.
Yeah.
And so, and if I can't do that with a particular stock and have it pay me enough money to take the risk, then I'm just going to pass on that trade. And I've had several of those lately where, like some of the semis, I think it was AMD or whatever, it just got away from me. I didn't see it. Right. And that's another rule. I don't chase the stock. And I don't say, well, it's up 18% since I should have bought it. So, well, maybe I'll take a shot and just buy a few shares. You might as well give it to charity on that, True, so yeah. I don't chase stocks because I used to chase them a lot. And it was kind of like golf, where every so often I'd make money on one that I chased, just enough to keep me doing it. Kind of like you go playing golf, and every once in a while you get that one that you drive right down the middle of the fairway.
Yeah.
You forget about all the balls that you put into the water and on the sand and, into the guy next to his head. I just got to get some better clubs. I need faster quotes. Yes. I need a better trading platform. No, you need a better process.
Now, those are all really. That's a lot of great advice there. Let's talk about something that we both gone through, and it is embarrassing for me to talk about this too. But it's capitulation. And it's kind of funny because I think we both go when in the accounts that we actively manage, we're not going to fall into that kind of trap. But we both have accounts that are more kind of retirement accounts or accounts that we don't watch, or we just are operating a different way, and I'm falling prey to the capitulation. When you see it like at the worst time, talk a little bit about the recent story that you had on this. That even you've been doing this for for so long now that you mentioned it before. You're human, Dan, and regardless of how long you do this, you can fall prey or get really close to these really portfolio destroying type of events.
Yeah, I have to put on my sunglasses and if I could, I'd like modify my voice.
we should put a blue dot on your head.
Okay. All right. Hello, I'm John Doe, and no, but so this is the thing. Like we have, first of all, what you were saying, the first part, like if you're trading your own account, you're never going to capitulate, and the reason you're never going to capitulate is because you have rules that are going to get you out before the fit hits the shan, like before the wheels come off the wagon and you're going, oh my God, is everything going to zero?
Yep.
You're out of that. And that's my biggest argument for running your own money. Now, we have, cause I have a company, we have a pension. I can't run it. Like I was telling you, Arusha, it would be like walking around with a t-shirt that on the back says, sue me, I've mismanaged your pension, or whatever. So anyway, so the thing is, this pension is being managed in an asset allocation model, which is something that, and I'm not putting it down other than the fact that it just doesn't work. But, I know a lot of large money managers use this where they're looking at standard deviation and this and that and the Sharpe ratio and blah, 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 and all that stuff.
Now, Dan, for large money managers, it makes sense for them, right?
Absolutely.
Yeah, but for individuals or for people who have the luxury of not having to manage a huge aircraft carrier or something like that, where it takes them long times to build positions in, get out of the positions. We don't have to follow those rules.
Right, exactly. Yeah. And so like, don't let my flippant attitude give anybody the wrong impression. I'm not talking about some dude who's running $500 billion, like you can't just say, hey, I think I'll buy some Twilio today. I mean,
right.
So they do that, they put them across municipal bonds and this and that. But for people like you and me, here's the problem. And this is what we ran into was, first of all, I'm a control guy and I hate it when I don't have control over something that I really kind of feel like I should have control over. And so when the market started really tanking on the whole, COVID boogie thing, I'm looking at the pension account and I'm talking to the guy and okay, well, how much are we down and this and that and the other. Oh, okay, well, that's not bad. And then like a week later or 2 weeks later, I'm going like, my God, what's going on here? Yeah. We're working for the last 5 years for free. And so I wound up calling this guy. I got to look at the date. I called the guy, the market actually bottomed on a Monday in March.
So I think it was March 20th. March 23rd was.
Yeah, March bottom, 23rd right? Was Monday.
Yes.
And so I called this guy on Sunday and I said, look, I can't take it anymore. You got to get us out of this thing. You got to get us out. I just can't stand to see this account go down anymore. I totally lost faith in the guy. And although, spoiler alert, it's not his fault, it's the method. It's not the person's fault, it's the methodology. And so anyway, then I'm talking to my wife, long story short. And then the next morning I woke up and I said, honey, we're defining capitulation here. We are the people that I tell people not to be. And so I called this guy up and I said, don't do it. Just leave us in, and so it's all good now. But I got to tell you, if I had not done that, I probably would have had to get on the old sunglasses and wear those every day as I teach people how to trade stocks.
Yeah. Well, and that's, that's a great point. It's, you have to have these rules especially when you're managing your own accounts. These are why we follow those rules. We may get stopped out, and 9 out of 10 times, those stocks are going to come right back without us. And you're wondering, oh, why don't I even have those stops? It's for that 1 out of 10 times that it just keeps getting worse and worse, and all of a sudden you've lost 5 years of hard-earned gains.
Just like that. And the thing is, you think about it this way. You don't even need a chart for this. You buy something at $100, you decide, well, you're going to sell it at 93 if it falls. Okay, then you go like, oh crap, it fell to 93. You know what? I'm not going to do that. I'm sure it'll bounce off of 90. And then it doesn't. And then it's down at 88. And then you go, okay, whoa, I blew my own rule. When it gets back up to 93, then I'll sell it like I should have before. Only it doesn't. It gets up to 92 before it falls to 80.
Yeah.
And now you're going, crap, man, what the heck? Okay, now when it gets back up to 88, then I'll sell. And so the thing just keeps ratcheting down lower and lower. All the while, you're forgetting about the fact that, you know what? Damn it, I should have just sold at 93 like I said I would in the first place. So when you have a rule like that and you stick with it, you avoid a big bunch of potential messes, And one like real easy one for people that are running like your own retirement account, or maybe you have, some money in the S&P or something like that, or just in anything. When the S&P falls below the 200-day moving average, you need to be liquidating. You need to be out. Why? Well, because everybody else is. All the people, all the institutions that would be buying to hold your stocks up, they're not doing that, because if they were, the S&P would be above the 200-day moving average. The momentum traders, and you know this, Arusha, momentum guys look at the 50-day moving average. When it's close to the 50, it's, quote, cheap. Larger money managers look at the 200-day. When it's close to the 200, it's cheap. When it's below the 200, run for your life. That's what they do. I've talked to them.
Yeah, no, that's perfect. So psychology and knowing yourself is critical to doing well in the markets. Coming up next, Dan and I are going to talk about a few ideas. Stay tuned.
MarketSmith will give you a huge edge in the stock market. Better stocks, bigger profits.
MarketSmith is the top research platform for IBD.
It's just the best tool for individual stock selection.
Everything within MarketSmith is designed to bring those best stocks to the surface.
It does a lot of the work for you of filtering down to the potential leaders.
It's when you take the training wheels off and you're ready to invest on a more professional level.
MarketSmith will help you take control of your investment life.
If you want to get serious about investing, start your membership today.
We are back with Dan Fitzpatrick on Investing with IBD, sponsored by MarketSmith. Okay, Dan, let's go into a few ideas. And the first one on the list is a stock that I own, Shopify.
Yeah. First of all, the stocks that I'm bringing, just so you know, I thought about stuff that's actionable. Like I wanted something, rather than saying like, oh my God, did you see such and such? The fundamentals look great. Not the time to buy it. You should have bought it 2 months ago.
Yeah.
So I want to give people some actionable stuff here. And Shopify is a really, really great stock if you look at the relative strength line there. It's rising, which we like to see. I've already said it doesn't have to be, but it's nice when it is. But also, by the way, Arusha, if you look at the stock when it was actually retreating there, the relative strength line was falling.
Yep.
So that's okay. And this is one of those where what's the EPS rating? 78.
Yep.
I love 78. It's my favorite number because it's not quite 80. So I like it. And also then from a business standpoint, and by the way, in this type of thing, you see what the accumulation distribution rating is pretty good too.
Yep.
So it's like all of the things line up on the chart. On the fundamentals, we're just talking about the earnings growth, quarterly earnings growth is off the charts.
Yeah.
I mean, it's just monstrous growth. And the same thing with top line sales, you know, 47%, 47%, 97%. Margins are almost 20% now. So this is a company that's crushing it fundamentally, but also just think about what this business is. Think about what we're doing now. Everybody's wearing a dang mask in the shower because I don't want to give the soap COVID or something. So we're all staying at home, right? This is enterprise software. If you go look at the website, they're basically saying, hey, if you want to start an online business, you start right here with us. I mean, this is perfect for what people are doing. And they're just crushing it. And as I mentioned earlier, I think what we're dealing with right now is kind of the new normal, and more people are starting businesses. That's not going to go away. And so these guys are in the sweet spot as far as just kind of culturally and economically what's going to happen. And this is what this is the kind of stuff that I like. And the weekly chart, it shows it pretty extended. And that.
Yeah, but still, still in this nice trend here. It's finding support off the 10-week line. I mean, you can really see the relative strength line, how sharp it is there. And I think, and one more thing here, Dan, the thing that sticks out to me and stuck out to me last time, during this run last time in 2019, I sold out at I think a 40% gain with Shopify, and I regretted it for months.
Nice.
It went up 100%, so that was a huge mistake.
It's a really crappy trade.
Exactly. But it was a huge wasted opportunity for me because I really love the story as you do. And so this time around, I was just like, okay, I'll lighten up, kind of like what you were talking about in the first part of the podcast. Don't sell everything. Take some off the table. Let those winners run, and and it also goes to the example of you're learning all the time too, and you're always improving on yourself and learning from those mistakes. And this is a real life example for me over the last few years.
Yeah, do you ever find yourself where you got the stock and it's moving really nicely, and then it falls like 3 days in a row? Or 4 out of 5 days, none of them really big, but enough to where it's drifting down and you're kind of a little concerned.
Oh, always.
Yeah. And then, so what do? You sell, because you don't want to give away your profits, but you got to think about, you got to think about it in this way. If I'm an institutional trader, like I forget what stock it was, but like Warren Buffett had to buy like 117 million shares of some stock or whatever it was. Well, that's not the kind of thing that you give your desk trader on Monday morning and say, okay, report back to me tomorrow by 5.
Right.
What price did you get it all in at? So these institutions go on these buying campaigns that have to, that they can be buying a stock for a year or more, at least a few months. But these stocks like this, like Zoom, remember PayPal, that kind of stuff. There's this underlying demand, institutional demand, like forever. And if you're kind of the retail guy that's sitting there going, okay, institutional demand, and then the stock falls for 2 out of 3 or 4 out of 5 days, and you go like, oh, the institutions must be done. No, they're just not buying right now because the stock's up too damn high. So they'll let it come down a little bit.
Exactly. And sometimes institutions will intentionally sell off the stock and try to cause some panic. And so they may come in and put like 100,000 share lot, hey, for sale, and try to drive that price down. Then they'll have a big bucket there as maybe even right below the 50-day moving average with 400,000 shares, and they're just grabbing all the shares into their big bucket. Now they've gotten more of their position.
Yeah, and the funny thing is, like, because we do have some institutional clients at Stock Market Mentor. We do. We got some guys actually running quite a bit of money, but most of our traders are retail guys, and there's this mindset out there that they think like the institutions are out to screw us. Like, oh, that was a fake move. They wanted to screw us or this or that. It's nothing about that. I mean, when I was back in New York for a very short period of time, that actually now, as I look back, was too damn long. But I talked to some of these guys and they don't talk about it that way. They talk about it like, well, when we need to generate some demand, then we push the stock up and then we get some demand for our stock. And then, oh, well, when we need to generate some supply, we need to buy some more stock. Then we push the stock down because that's where supply is. They don't personalize it. They don't personalize it. They just look at the chart. It's like Wyckoff's composite man theory, where you just think of the market as one guy who's doing what he can to advantage himself, not to disadvantage you, but just to advantage himself.
Right. And or think about the market as the biggest poker game in the world, because I mean, one thing that I tell this to a lot of people, but the stock market really isn't here to make you money, right? And it's for everyone's battling for that money. And so I take it to that extreme level. It's like, it's not here to make you money, it's here to take your money, right? And so that's why you have all these rules in place, so you're forced to raise your game up. So you're not falling prey to that, because you have a plan for place to help you manage extreme kinds of markets like we've seen this year.
Yeah, I agree with you. The market's kind of there to take your money, but it is interesting to me after, where I've been doing this I've been teaching people to trade for longer than I've even known how to trade. Just don't tell anybody. But people ultimately get to where they need to go, where they have a rules-based system. It doesn't mean robot. It just means like there's rules, and we've been talking about some of those. But how they get there is really interesting, because I see, in the people that are coming through our doors, why is it that somebody can not have a position in a stock, and then the stock pulls back a bit, and the one person is saying, is this the time to buy this stock? I think maybe I need to buy this stock. And another person is looking at the same thing and they're saying, oh, if that falls another $1, I'm going to short that stock.
Yeah.
Like, you know what I mean? Or somebody that has a position and then it pulls back, like we were just kind of describing. And that person, there's one person that says, great, this is a chance for me to buy some more of this. Yep. And then another person says, crap, now I'm back to where I was. I got to sell the stock. So it's like they're both seeing the same chart. They're not really seeing different things. They're seeing the same thing, but they're bringing different psyche into it. Some people, and I'm this guy, they're scared to lose money.
Yeah.
Other people just want to make money. They just like, yeah, this is an opportunity. And, I've been on the couch, on my buddy's couch, a long time ago when I lost everything and then some stuff that I didn't even own. Mm-hmm. And so I grew up in that environment where if I have money, the last thing I'm going to do is lose it. Like, right. I got guns. You're not going to get my money. Yeah. And so that's a different mindset than the person who's always had money and just wants to make more of it. And so the trick is for both of those people to get to the same place. They come in a different direction, but they got to get to the same place to where they do have a rules-based approach. They do buy when certain parameters are met, and then they sell when other parameters are met. And it is, as we said a while ago, a lot of it's art. You can't just say must sell at this. Yeah. But if you keep track of your numbers, like we were just talking about it before I came on, can I give you my numbers?
Yeah, for sure. Yeah. if you
Yeah,
wanna give
just
the
real
numbers. Yeah.
quick. On our growth stock list, we keep a growth stock list at Stock Market Mentor where I give people like stock, entry, exit, stop, stuff like that. So we're batting 54%. It's better than average. I'd like it 60. If I could do that, I'd be happy, but I'm reasonably okay. Our average profit's 13.14%. Our average loss is 5.7%. So we're making more than 2 times the money than we're losing, and we're batting over 50-50. So
Yeah, it's a winning formula right there.
those are good numbers. Like, they're not monster numbers, but they give me a sense of, okay, like, where am I? Where am I? Am I doing okay, or am I not? If I trade based on my performance, if I trade more, am I going to do better, or am I going to lose all my money? Like, that's the type of thing that we were talking about as far as keeping track of your trades. If you have those results, then here's the other thing. Based on my performance, if I have a stock that's up 15 or 16 or 17 or 20%, I'm thinking, oh, I can improve my numbers if I'm taking some profits here. On the other hand, if I have a stock that's down 4, 5, 6, 7%, now I'm thinking, crap, I better sell this thing because it's already lower than my average loss.
Right.
So it's not about the position. It's not about the stock. It's about the numbers. It's like, no baseball player is going to crow because he got 3 for 4 on Tuesday night. But if he's batting 400 over the season, that's Hall of Fame numbers.
Absolutely. Okay, let's go to the second stock, and this is Dynatrace, and ticker symbol DT. And I will let me bring up the charts here again. And so for those of you who are listening to it, you can also watch this on investors.com/podcast. And so ticker symbol DT, here's Dynatrace, a newer company setting up. And this is something I noticed over the weekend too. I was like, wow, this is really tightening up and setting up nicely right on that 10-week line. And they're putting up some big numbers too. What do you like about them, Dan?
Look at the daily chart. Check out the daily chart.
Yep.
Now start drawing some lines there. You see a horizontal line at $40 for support, right along there. And then you draw that line along the downtrending resistance from that 44.65 down there. That's what I call a pinch and pop pattern. Shorthand for that is the pimple pattern. But what it is it's just the type of thing that I was describing, where you've got a nice uptrending stock that's in consolidation, gradually coming back to the 50-day moving average. A stock like that has, especially a strong stock like this, it has an excellent chance of breaking out above that volatility squeeze. Like, that's a volatility squeeze right at $40. And so for me, when I look at that stock, my buy point is like $44.45.
Okay.
If it breaks out above there on volume, it could do this. And for all I know, it's going to do it before this podcast is even published, because today and yesterday was much heavier than average volume.
Yeah, you're right. The podcast will be released Thursday afternoon, so tomorrow during the day, this very well can move, because it has been setting up. They have monster numbers here with the earnings and the sales, and the IBD ratings are excellent too, and they're in the cloud. You're in the cloud, and you're helping make companies more efficient at lower costs. You're going to be doing pretty well right now.
Yeah. This is, and by the way, if tomorrow this thing falls to like $35 or $30, and it's before this podcast is posted, can I call you back and tell you to erase this part?
We'll go into a retract.
Got to do another segment there. So anyway, so I like Dynatrace. And again, because I hate the charts that you look at, and then somebody will go like, oh my God, isn't that an awesome chart? And you look at it and you go, no, because the stock went up 30% and I wasn't in it. So no, that chart is a horrible chart. Show me one that looks like this did before it made that big move. And so that's the stuff that I'm looking for. And Dynatrace, it could be one of those. We'll see, but it's got everything in its favor. And I do like the volume coming in.
Yep. The volume, it has really good.
And if you look at that, Arusha, that big, the highest volume bar 3 days back at 10,600,000.
Yeah.
That actually occurred on the day where the close was higher than the open.
Oh, look
the
at that.
stock closed within 7 cents of the intraday high. So even though that that bar looks like it's a distribution day, like, oh my gosh, it's horrible. Yeah. That's actually the day that the rally started.
Yeah, and it came really close to the 50-day and came out. And what kind of surprised me with this one is that range is so small too. There's a lot of volume, and maybe there were some really large two institutions just exchanging a large lot of shares there at a specific price, maybe in the dark pools or something like that, and came out right at the end of the market or something, maybe something like that.
Yeah,
so it's
it could. Yeah, it certainly could be. But the thing is, however that volume occurred, it did occur right there. And so I look at this, and it's one of the best charts I've seen, this week as far as more potential.
Yeah, absolutely. This was definitely on the top of my list over the weekend. I was like, wow, look at Dynatrace. So that's Dynatrace, ticker symbol DT. One to keep an eye on, and definitely could be actionable over the next week. Let's go to one more, and this is one that everyone should know, and I'll go to the daily chart. And we are using Zoom. This is a ticker symbol ZM. This is, I would venture to say this is the best stock in the market for 2020. On a performance basis and also just on a functional basis as a company, because they have changed everything and they are the perfect company positioned for the craziness that's going out there.
They really are. And the funny thing is, you'll hear people say like, oh, they have security concerns,
Yeah.
I'm going like,
which is right here, Dan. They had the security concerns, brought it right back to the 50-day for someone. And I was, what happened? It affected me too, because I was scared to buy at that point. But But
so here's the thing on that. Like, oh, they have security concerns. Okay, well, do they not know about it? Is this something that everybody knows about, but Zoom doesn't know? Or might it be the kind of thing where they go, we have security concerns. Well, we better fix that.
Yeah.
I mean, so they have security concerns. It's not unfixable. So it's kind of like, with Facebook, I'm not a Facebooker, and I'm definitely not a Zuckerberg.
I was going to ask you to be Facebook friends after this.
No, I'm not. You can talk to somebody in my company, because I don't know my password. But we do have an account. I think I have a perfect life. If you look on Facebook, at least that's what I want you to think. But so when all these businesses are boycotting Facebook, I mean, that was an opportunity to buy Facebook, because once again, is Facebook not going to do anything about it? Do you think Zuckerberg and Sandberg are going to go, oh, well, shucky darn. You know what? It was good. It was a good run while it lasted. Now what are we going to do? Let's build electric cars. So when a news item comes and it hits the stock, you have to not think so much about how bad the news is. Think about whether it's a fixable thing. And everybody wants to make money. They're going to fix it. So like with Zoom, and I almost didn't want to mention the stock because it is so obvious.
Yeah.
I mean, it's like Zoom video. Really? Gosh, thanks for the idea. Okay, well, do Zillow instead or something. But the thing is, I still think this has upside potential.
It gave that opportunity just over the last week or so. Everyone kind of forgot about it. They just, we missed it.
Yeah. Well, the thing is, I was looking at this stock, and this is one of those that I made great money on way lower than it is now. This was before I decided that I had my 10% rule, where if a stock's going up, just put 10% away, just like you do when you're in the blackjack table.
Yeah.
You know, you kind of squirrel some chips into your pocket so you
That's
don't wind
smart,
up with
yeah.
nothing.
I haven't learned that lesson yet.
Yeah, it is. It really does help. But so the thing is with Zoom, one of the things that I like to do is I call it envisioning. I will look at a chart, and so I'll start drawing the the vertical lines, projecting what I think a stock can do in the future. And it's not like a price target or anything like that. It's like, you know, okay, over the last few decades, I've looked at like millions of charts. You know, what looks like a pretty reasonable price pattern for this? Expect the expected, not the unexpected. Like, what would I expect this stock to do? And so my expectation was that the stock would kind of continue, and my hope was it would kind of continue to drift sideways long enough to test the 50-day moving average and then hold above that. Well, that's what it's doing. And so right now, like if you look at your chart, I want to buy, and I did buy as close to the 50 as I could. And then as long as the stock stays above the 50-day moving average, it's acting in accordance with how I envisioned it to act.
Yeah.
Therefore, I'm not going to be shaken out because I've already done the planning. Before I get into the stock, I've gone, okay, well, you know, this is my idea of what the stock's going to do. So, Dan, if the stock does what you think it's going to do, then would it be acting reasonably? Well, yes. Otherwise, I wouldn't buy the stock. So as long as it's generally conforming to what my envisioning was, what my imagination was for how the stock would trade normally, then I'm going to stick with that position. I'm not ever going to be tempted to sell it. Now, as soon as it stops acting the way I thought it would act, and in this case, it would be like if Zoom like fell down to like 235 or 230.
Yeah.
Okay, now my trade is blown because it's not acting the way I thought it was going to act. So just using my imagination a little bit totally keeps me straight. It keeps me more objective because I've already kind of done the mental work.
Yeah, no, I mean that's well explained. I'll just show the weekly chart just very quickly here. Just a super strong move, and so I own shares of it. I added over the last week or so when it came right back and touched that 10-week line. That's the first time it's touched a 10-week line in a while. So I've just learned over the years, hey, for some of these great stocks, you're better off just trying something there. If you get stopped out, you get stopped out. But it's always really hard to get into some of these great stocks if you don't take that opportunity when they come and touch the 10-week line.
Well, you know what, Arusha, I don't know, but I'm not even sure that it touched the
I think it might not have even.
Yeah. Well, the reason that's important is you think about it, like that's when a stock, you know, you'd typically expect it, like if it falls to the 10-week line of the 50-day moving average, then, you know, probably get some buyers there. Maybe it'll even drift a little bit below it. And then if it comes back up, that's a good thing. But if you've got a stock like Zoom that's been consolidating for several weeks and it doesn't even touch the 50-day moving average, it comes close, but it doesn't even touch the 50 before it starts moving higher again, that is a really, really positive sign. You can just envision these traders sitting there going, oh man, it's almost at the 50. Well, I better buy this thing before somebody else does.
Yeah. And that's this market, and that's a characteristic of a very, very strong stock. They make it very difficult to get into. Yeah. And and that's something I've missed so many great stocks over the years that you just learn if it's close enough, let me start buying slowly.
This is a 10%er. This is a 10%er. Just whatever your average position is, if you go, I just can't take it anymore, just put 10% away and, you know, you thank me in 2022.
Yeah, no, I like it. So there are a few ideas that are worth adding to your watch list. Thanks, Dan, for joining us today.
Yeah, thanks for having me. I really appreciate it. It's been a lot of fun.
Next week, we are going to have someone who's a friend of both of ours. Dan mentioned it already. Mark Minervini is returning back to the show. Mark is the founder of Minervini Private Access and was also featured in the Stock Market Wizards book a number of decades ago. So that's it for this week on Investing with IBD. I'm Marusha Pires, and thanks for listening.